Welcome back to Golden Rule Radio, your weekly recap of the precious metals markets and the other markets loosely adjacent to the precious metals. And Rob, it's good to be back in the studio. Appreciate you and Tori carrying the full weight of the show last week while I was on a well-needed vacation.
Well, it was hard pushing the rock uphill with just the two of us, Miles, but we slogged through it.
Well, you know, Tori's a small guy and you're old, so somebody needs to bring some man muscle.
And it's a big rock.
Yeah. And I'm large and gangly. So I guess between the three of us, we'll figure it out.
Let's talk bonds.
Let's talk bonds, because we've had some bond stuff take place over in Japan this month, which we'll look at. And we've got some bond stuff about to take place here in the U.S., which you're going to talk about. So
the U.S. next week is going to be bringing a big auction increase from last time, which didn't go well. The last auction did not go well. And they're going to make it even bigger this time. Plus, they have an FOMC meeting where they're going to talk rates again, plus payroll numbers. Next week's going to be a pretty volatile week. The biggest problem with the bond market is that the spending is out of control and it's being picked up by the traditional media. We talked about the Financial Times and the Wall Street Journal's comments about fiscal irresponsibility. But as we talk today, at least we finally have a Speaker of the House. But he's got a lot to do in the next couple of weeks. What I'm concerned about is there appears to be little political will to rein in spending on Capitol Hill. Government spending so far year on year is up 14%. Tax receipts are down 7% year on year. With fiscal year projected next year to have a deficit of $2 trillion, roughly 8% of GDP, the deficits of this kind of magnitude are not good. If we roll into a recession, which almost seems a certainty, we could be looking at deficits as high as 20%. The problem is if we have 20% deficit of GDP in the next few years, that's like a $5 trillion deficit.
It's a big percentage increase.
Right. And
I mean, it's a big nominal increase. $5 trillion is a lot of money, but it's a big percentage increase. In the chart you're flipping through, the next one you got sitting on the table right there, I'll throw this up on the show right now. This is government spending. This isn't deficit. But you look at the spike in government spending spike that we've had here this past year has dramatically overshadowed anything we've ever done in the past, including 2020 COVID, including the 2008 market crash.
And we're not in a fiscal problem.
Supposedly.
We're not in an economic problem.
Supposedly.
Yeah,
so that's what the White House keeps telling us. They just keep redefining what the word recession means. So where's the spending coming from? And as you just pointed out, if we're talking about increase in spending on top of a decrease in revenue coming in from tax receipts by the U.S. government, we very likely could be looking at this continuation of $1.5 to $2 trillion a year added to the deficit every year, and probably increasing, because it's going to have a multiplicative effect over time. I made it through that word. You should be proud of me.
I am proud of you.
Thanks.
And who's going to be buying bonds? It's proven here in the last few auctions that foreign investors are no longer fleeing to the dollar as flight capital, as a haven of safety.
Right.
They don't see it that way. They are buying gold. The buyer of last resort will be the Fed. So the balance sheet, which has been trending down from $9 trillion to $8 trillion, I believe we're going to see a big reversal in the balance sheet and more money hitting the economy.
Well, it looks a lot like what happened during the Trump era, where they started to top that balance sheet and even begin to bring it down a little bit. But then, of course, 2020 happened and they just ballooned the whole thing. Could they be giving themselves a little bit of runway? So we go up to $9 trillion again. They say, well, we were already here. It's no big deal to come back here. We've got this extra padding. And I don't think so.
Yeah, but if you're running deficits now of $2 trillion annualized, soon to be $5 trillion annualized, that's got to go to the balance sheet. I think Japan, few people actually pay attention. I mean, it's not that Japan doesn't matter. They're a huge ally of ours, and you don't want Japan to do poorly. I really don't. It's a great nation. Their problem is their central bank is buying bonds. They are in that yen doom loop where they are the biggest buyer of their debt. They're also the biggest buyer of their stock market. And I wonder if our Federal Reserve isn't looking at the Bank of Japan posing as a model for what they can get away with.
Yeah, that would be my concern too. I mean, we've seen 6 bond buybacks in Japan just this month. And as you brought up a second ago, the last U.S. bond auction did not go well. So what the U.S. has decided to do when nobody wants to buy it the first time, just bring even more to the table next time. The next bond auction is going to be even bigger than the last one. If there were no buyers then, where do they think the extra buyers are going to come from now?
Exactly.
So it's all going to get folded back into the Fed somehow. And it's getting folded back in at significantly higher interest rates than when it was issued a few years ago.
Correct.
So this is potentially catastrophic.
Well, look at the Fed's discount rate. We went from 25 basis points, 0.25%, to 5.25% in just a matter of a year or two, 3 years, let's say.
Sure.
That's a huge spike in interest rates. And that's got a lot of borrowers upside down as they seek to refinance the debt on their books that isn't doing well, with assets that are coming underwater, especially in commercial real estate. We are really headed towards something we haven't seen in decades.
And look at where we're seeing the response to this. We're seeing it in the gold market, not all precious metals.
No.
And I think that's an important differentiation, is we're seeing it in gold, not silver, not platinum, not palladium, not rhodium. We're seeing it in gold, and we're seeing it in the equities market across the board.
Well, let's talk about silver for a second.
Sure.
Let's pull up the silver chart. It still hasn't broken above its declining trend line.
Correct.
But gold, on the other hand, dramatically has.
Yeah, I think that's a very key point. They both did sort of the first step you need. When you're in a long-term trend and you have corrections against that trend, there's certain things you look for to say, is this just a correction against the trend? Is the market just blowing off some steam for a few months? Or are we in a trend change? And one of the first things you'd look for is, are we putting in some type of significant lower low? And when we were sitting in here a couple weeks ago, both gold and silver were getting real close to the previous lows, to where even though they've been trending down for the last couple of months, you can still argue the long-term movement in the metals is up.
Still positive.
And what happened? Neither of them were able to put in lower lows. And in fact, they've both bounced pretty aggressively back up.
They did.
So we've seen step one.
For silver.
And gold.
Well,
we saw step one in gold as well.
Gold is on its way to somewhere between 2,500 to 3,000 in fairly short order. And that sounds incredibly bullish, but I don't know any other future but that.
No, and I completely agree. So what are some of the other steps we need to do to get there?
Yeah.
Well, here's something else gold has done. It did break back up into, not only into, but above that declining channel. It came back down and it retested that declining channel. And now we're up into the trading range of the previous all-time high. Now, it's a big trading range, but that usually happens when you've got a lot of volatility at all-time high pricing.
Right.
But gold is now scraping what I would call the neck of the head. You know, if you call the all-time high the head, like the head and shoulders concept, we're kind of right at the neck right now. So we're down to the very last little section of resistance before gold's 21 plus, and then we're 25, and then we're 32, and then we're probably seeing some type of correction similar to what we've seen over the last year.
Correct. Yeah, I agree with that. And there will be a buying opportunity, but depending upon where gold peaks out, say you have a 50% correction, a 50% correction starting at, let's say, 1,800 at 2,500 puts you where?
2250, 23.
Right. Yeah, so with gold trading between 1970 and 1980, what a time to get in.
Right. Now, silver, on the other hand, hasn't done some of those extra steps, but we've been talking about this for a long time. Silver continues to lag behind gold. It does the same thing gold does on a longer timeline with more aggressive volatility in the meantime. Silver's got a long way to go. I think it's still the silver horse, not the white horse, although we do call them the white metals, so maybe it is the white horse. But look at when silver finally made its move during the last bull market. Gold was done, and then silver triples. So let's not forget, for those of us that are silver buyers, it's a patient man's game. Most of us don't have the stomach for it. If you do, it's a valuable payoff when you're staring at the ratio chart, not the dollar price.
Correct.
If you're staring at the ratio chart, it's obvious. If you're staring at the dollar price, it might get heartbreaking, because how many more years can silver spend in the mid-20s?
Oh, I don't think much longer. I'm curious as to where the ratio is right now.
I think we're sitting in the 85, 86 range right now.
Mm-hmm.
So still a buying opportunity for silver, but that's going to trickle out. I mean, if you look at the ratio chart, it clearly topped out at that 120. We've made a massive step back down that I think broke 60. Didn't we get down to about 58, maybe 60, maybe 62? And then we had to bounce back up. So you have 2 steps forward, 1 step back. Well, we're going to take 2 steps forward again.
Mm-hmm.
And that's when getting into a silver position, while we're seeing gold pushing up to start testing all-time highs again, silver's still lagging in the low to mid-20s. That's not a bad time. You said it's a great time to add to your gold position. Take 30% of that and pick up some silver eagles as well.
Sure. Why not?
So finally, there's the optimism buried within the pessimism. You want to go back to pessimism for a little bit?
Yeah, let's talk about the dollar. I think there's a strong likelihood of the dollar getting hammered next week.
I think you're correct. You know, Rob, through your years of wisdom, you gave me a really nice long explanation when I asked you a pretty simple question here a minute ago. I said, Rob, do you think they're going to raise interest rates? And you responded with a lengthy
no.
Yeah, exactly. So end of the year, looking at what's going on with the equities market here, considering a massive bond auction coming up, I think you might be right. And I think we're looking at the dollar probably stalling out.
I think it will, and I think stocks are going to follow. I mean, you're looking at S&P stair-stepping down. Same with the NASDAQ stair-stepping down. And the Dow stair-stepping down. Transports really got pummeled.
Transports got kicked in the shins over the past week.
So they're definitely stepping down.
Yeah, and again, it comes back to the old adage of, is it a correction against the rising trend, or are we looking at a reversal? And I think long-term, if you really look at the equities market over the last couple of years, the fact that we didn't get closer to those highs that we put in the previous year, and we came back into them here a month or two ago, the fact that we didn't get much closer and we're starting to step back down again, I really think there's an argument that we could continue to be looking at the equities market rolling over. The argument of Dow theory has always been the transports lead the industrials. If you're not shipping goods, you ain't selling goods, unless you're the Fed trying to do a bond auction, and then you just keep shipping more goods and hope someone buys them. But for the rest of us out here in reality, if the trucks aren't moving, you're not selling anything.
Correct.
And the transports got crushed.
They really did. And one last pitch for gold. If you thought gold has been strong with a rising interest rate headwind, as well as a strong dollar headwind, you just wait until rates flatten out, and even who knows what rates are going to do long term. There's no way the Fed can keep rates where they are. There's no way, in my opinion, that they can target an inflation number, at 2% like they have been. They're going to have to readjust their inflation rate because nobody's buying their bonds. They can't sell them at these rates, so I think interest rates could easily drop as the stock market rolls over, and then watch gold.
You know, I've been saying for years, this is where we find out who Jerome Powell is. And I know I've been saying it for years, and I'll probably keep saying it for years, because kudos to the guy for not giving up the ghost yet. But I stand by it. This is where we continue to see, this is where we see who Jerome Powell is.
Yeah.
Is he Greenspan?
Or is he Volcker?
Or is he Volcker? And if we see a little bit more down in the Dow, if we see that 20% plus decline that we had in the S&P here, what was that, a year or two ago? Yeah. That 20% plus decline, if we exceed that to the downside, now we get to see who Jerome Powell really is. So that's going to do it this week. Thanks again, Rob, for covering for me last week and joining me again this week. We appreciate you all joining us. If you liked what you heard, you can hit the YouTube buttons. Better yet, swing on by our website. We can be found at McIlvaney.com. We're also on Twitter at ICA Gold or Facebook at McIlvaney Financial. Better yet, give Rob, myself, or anyone else here at McIlvaney Precious Metals a call. We can be reached at 800-525-9556. Thanks for listening and have a great week.